Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. Quite excited to be broadcasting live today. I know it's been a while since we've done that, although fortunate to be joined by Bob Coleman of goldsilvervault.com, who really has quite an insight into the markets because in addition to running the gold and silver vault where he helps people get physical metals on the dealer side, also runs a hedge fund and is deep into the inner dynamics of what's going on between the COMEX, the physical market. He's also been commenting a lot on SLV, where we've seen a large short position, shares getting hard to borrow, getting a little easier to borrow, and obviously a lot going on in the world that I think is driving people into the precious metals. Same time, we've seen the price come down. So plenty to dig into today, and we'll also be taking questions. And with that said, how about a big hand and welcome on in Bob Coleman. Bob, great to have you back on the show, and nice to meet you in person last month at the Silver Symposium. How's everything going with you today?
Good, good. You're a lot taller than I thought in real life.
Well, I
So,
heard that is, I do appear bigger than in person. Some people have noticed I'm a little taller than Keith Newmeyer, so they were surprised. Yeah, it was good to see you there. And how did you enjoy the symposium overall?
yeah, it was good. It's nice to meet a lot of people out there that have interest in silver. Yeah, a lot of people that had just questions, that frustrations, curiosities. I mean, it's to me, it's trying to help people through this journey. Because we're all learning. I mean, to say that somebody knows everything about the markets. I wish that was the case, but it's a constant sort of game of a cat and mouse. You're trying to figure out why things are moving the way they are, and of course the market shifts and changes, products are created, and so you try to figure out, well, how those products being created influence the price, and so it's trying to help clients through this narrative, instead of getting sort of flushed out of the position or just getting frustrated to the point where, like, listen, I'm done with this metal. I just want to get out and walk away. There are things that actually create, it's not all just simply, hey, it's manipulation, the price is never going to go anywhere because the banks have a foothold on it. It's a much deeper environment than that. That's what I'm trying to uncover and help people through, because and through that process, if I can do it correctly, I can, and it's getting people to look at the actual metal itself and get away from these paper structured products. I think that'll help the environment, or at least the price going forward, because I see some exciting things going down the path with silver. I don't know how the paper products are going to react to that, but in terms of the metal, there's real demand for it, and how to capture that appreciation in price. To me, the metal makes the most sense, versus, I don't, you could buy SLV or PSLV or any of these other things. Yes, they could go up in price because they'll, mirror the price movement of silver, but you just have other factors that, hey, if we're right on buying silver and it's an insurance policy, it's not just simply inflation or whatever, and you have a dislocation in the market, then all of a sudden these paper products that may have been great representations of price turn out to be a potential liability. And that's what, again, trying to re-educate institutions and high net worth investors to say, listen, I think that the physical, it's not as cumbersome and illiquid as people think it is. It can be just as liquid as trading SLV, but at least you have the counterparty risk and systemic risk issues that the answers or the solutions for that you don't have with paper products.
Yeah, I think that's well said. And I was actually going through your last Twitter Spaces call from last week, took a listen to that again yesterday. And I thought you phrased it well, where people were saying, well, is there really any purpose for SLV? And yeah, I think if you're trading or want to take a short term position or do put or call options on something, that it has its rightful purpose. Yet I think there's also a lot to be said for in the times of illiquidity or chaotic market. Again, we think people were shocked by what they heard with those prospectus changes back last year in February of 2021, where in certain conditions we may not be able to source enough silver. And I think that rightfully so leaves a lot of people questioning what exactly is going on. And as we get started here, I'm going to pull up today's price chart of silver so people can get a look at that if they haven't been staring at it all day already. Slightly below $19 on the Kitco chart. Bob, as you talked about, and certainly we experienced firsthand back at the Silver Symposium, a little bit of a tough environment about a month ago where each morning we're waking up, going to the conference, silver seemed to be down 30 or 40 cents. Since then, particularly the last couple of weeks, the dealers I've talked to, seeing a lot of buying. I've heard reports of wholesalers telling them that a lot of products right now check back in 2023. I think people are seeing the increased premiums, and again, there's that frustration of why is the premium higher yet the price is down. So maybe we could start there, and with what you're seeing on that side.
Yeah, on the wholesale level, you're seeing a lot of products backed out, 2 to 4 weeks, I guess you could say. A lot of bar product is maybe 4 weeks out, depending on the product. Some of the coins, you do have some of the issues with the crossover in 2023 years. They're not making the 2022s anymore. And so you have depending on which mint, if it's Royal Canadian or the British Britannia, that may be coming out the next month or two before 2023. But the US Mints Eagle program, they don't start distributing until I think the second or third week in January. So you have this sort of gap in time that you have just less product available. And the question is how much more premium how much more can the premium expand, given that we're probably going to see a wave of coins coming onto the market in the next couple months. So that's part of the issue. And of course, the other issue was the king coming onto the face of the British Britannia and the Royal Canadian Maple Leaf, or the Canadian Maple Leaf coin. And when are they going to have that tooled up and the dies made and all that type of stuff? That might be the first quarter, end of first quarter next year, or maybe mid part of the first quarter. But that's another issue. So you have some artificial constraints or temporary constraints that the market wasn't maybe expecting. On the bar side, talking to the wholesalers, mainly it's expanding to about 4 weeks out on a lot of products, to be comfortable on saying. Premiums have gone up a little bit. We've seen maybe on certain products, maybe 50 cent to maybe 75-cent increase in premiums on 100-ounce bars. I think I'm at $3 over spot now for Pamp Swiss 100-ounce bars. A little bit less than that for other LBMA products. So hopefully, and you can go on our website, goldsilvervault.com, and there's a pricing section for we list some of the prices of products that we sell. That way people can get a guide for what we do, as well as maybe how to compare that with their dealer. As I tell clients, use that pricing list to maybe negotiate with your dealer, get a little bit better price. Because to me, I want the investor to get the best experience in the market. I hear a lot about with the prices pulling back now from the mid-20s down into the teens. A lot of people are just frustrated with what they paid for the product back then and the performance of the metals now. Now the problem is they're playing catch up, and you're seeing the spreads widen out with on the offer side, but the bid side doesn't really catch up to that. And so I think the consumer is becoming a little bit more educated. But I still think the issue is going to be tightness in the market really through the end of the year. Because of this coin issue. And then the issue that I've been saying for quite a while now is the 1,000-ounce bar market, which is the best value out there. You're seeing investors gravitate to that because as you get to silver 100-ounce bars at $3 over spot. I mean, the funny thing is I'm probably cheaper $1 to $1.50, I think, than a lot of dealers out there for the same exact product. And so, but even me, 90 cents over spot for 1,000 ounce bars, that's delivered here to the vault. If it's drop ship, it's 95 cents over spot. There's some value there that you're going to be able to get with at least get participation in silver itself. So if you're trying to maybe get more metal for your money, that may be a product to look at.
Yeah, and certainly with the 1,000 ounce bars, I'm going to pull up a graphic we have here from Michael, who posts some good information on the COMEX, where we've seen the registered inventory now drop below 40 million ounces. I know you posted this and shared this today as well, Bob. Premiums up a little bit. At what point do you become concerned, or should one become concerned? We've seen a pretty steady drop ever since that silver squeeze, where kind of almost in a straight line with a little divot there perhaps, but now under 40 million ounces. And I know you were saying that a lot of the products that are unavailable now is kind of as they're changing over to the 2023s. Are there also products that are unavailable because it's getting harder for manufacturers to find silver? Are we not at that point yet? Any guide as to when we get to that point? And again, thoughts on the declining inventory in the registered stockpile?
Yeah, the structural issue that we're walking into is silver is becoming, with the price coming down, you're seeing miners maybe pulling back on inventory or pulling back on production, or they could be trying to roll their forward commitments to try and maybe extend and see if the price starts to tick back up, but not making the delivery maybe on the time commitment they said they were going to make that delivery on. So that's putting some pressure on sourcing of metal, and that's what's causing that. I reported on that in August, that you had refiners that were taking delivery off the COMEX for the sole purpose of fabrication, and they were seeing mining slowdowns back then, and then it turns out, and Steve San Angelo put some good information out with regard to Peru's production dropping, I think 11%, and a couple other countries. You're seeing a slowdown. I think in Australia, they had a slowdown as well. But you're seeing the price impact affecting the production impact or supply of metal, and that's what causes this backwardation, meaning, when you start getting a tightness in supply, people will pay up for that immediate silver to make product with, because silver 3 months out doesn't mean anything to someone who's trying to sell a hard product. And so you have funds that are shorting the market down, and they're using primarily the futures or some paper investments, SLV, something that they can get exposure on the paper side, as well as ability to leverage. And that's forcing the futures market. Oops, sorry about that. Let me just hang on a second.
The silver price is jumping, and it caught them off guard.
Yeah, I just have a yeah.
That's all right. While you're taking a look there, I'll pull back up that chart that Bob was mentioning from Steve St. Angelo. And I did see we have a Steve St. Angelo question in there, which we'll get to in a minute, but here he is showing Peru's annual silver production down. And Bob, are you ready back with us now?
Yeah, sorry about that.
No problem.
Yeah. Yeah, so you have a number of things that are happening that you haven't seen before the last couple of years. There's one of the things that I've been really adamant about is not trying to fearmonger, not trying to hype, and not try to create expectations that maybe can't be met, or just trying to sell product and trying to drum up some interest. I don't really like doing that. What I do though is if the market's trying to tell me, hey, listen, we have some issues that are developing here that you may want to look at, because I run a hedge fund, I manage money, so I have sort of a fiduciary responsibility to try to give objective information to the client, that type of thing. So what I see happening here is with the price being pressed lower because funds and CTAs, commodity trading advisors, and so forth are seeing the slowdown in the markets and basically saying that's going to be less commodity demand going forward. So therefore our playbook is let's short the market because commodities tend to get hit when the economy pulls back. What we're seeing though is on the physical side of silver, the investor side is picking up as the prices pull back, and it's creating this backwardation, this dislocation, and it's extending outward. And the metal that's coming off the COMEX, and I've been saying this for two years now, when we hit 150 million ounces of silver in the registered category a couple of years ago, that was it. I said there's only one way to go now. That's down, because ultimately all the metal that would have been put on the market for arbitrage, for leverage, for collateralization, financialization, it was put on the market because you had the spreads blow up back in 2020 between London and New York. So it made a lot of sense to put metal onto the COMEX, play the role or get the arbitrage, the difference between the London and New York price. But that's played itself out. So now the issue is people are buying physical metal in sort of an inflationary time period, which we haven't seen in 2013. We didn't see that. Everyone's saying, well, God, you have the bear call, which is basically the metals are about to drop out of bed. Silver and gold are going to do exactly what it did in 2013 when real rates went positive. All of a sudden you had that 20% drop in one day or whatever it was back in 2013. And I think half the industry started taking Xanax at that point. But I think we're in a
good stat to track: Xanax versus being a silver investor over time.
Yes,
correlation there.
Yeah, it's called thinning hair. But I think we're in a different environment. And I never like to say it's different this time. To me, that's what I'm looking for is the environment that we're in. And back then we had real rates were rising, but you were having consumer confidence rise at the same time. You had the economy actually rising at the same time. Here you have the interest rates rising, but you have consumer confidence declining. You have inflation picking up, which you didn't have in 2013. You have the stock market declining as well. You have the bond market in complete chaos right now. That's gotten hit really hard. So you have certain factors that are creating confidence issues. And I think that's where the metals will actually do really well, is they tend to do well in times of uncertainty and sort of political confidence. Or economic confidence in the markets. And I think the setup is being born here where paper guys are short big on the metals. And I think I posted this thing over the weekend about open interest on the COMEX. Open interest has been in decline big time. And it's telling me that the liquidity is drying up. So if the market is too short on the COMEX, and all of a sudden we do have a base formed on silver and the market starts to move higher, the question is the short position, if it's structurally too short, you're going to see what we had happen in 2010, 2011, where the market just starts taking off. And then all of a sudden shorts are scrambling to try and cover on every little pullback. And silver, that's why when silver moves, it moves like a hockey stick, because it tends to move it tends to, because it's a small market, it tends to get pushed around a lot easier. Now, the interesting thing you said with SLV on the perspective change, when they mentioned the inability to get silver, I think that's a possibility that they're looking at. And this is how it would affect SLV. Some people say, well, God, that means the SLV is just going to implode. Well, not necessarily. SLV could go to a premium, and how and like you were mentioning the spaces call I did last week, and I went through the SLV ETF and the structure of it. I went through read all the agreements between the authorized participant and the sponsor and the trustee and depository, all that type of stuff. What would happen in that type of scenario would be the authorized participants normally when SLV goes to a premium, the authorized participant will issue more shares and sell those shares into the market, buy silver and deliver that silver to SLV. And there's a spread or an arbitrage that they make doing that. That's how the ETFs, and we can get into that if you want if people have questions on how SLV actually works. But if they can't get the silver, they can't create the shares. So therefore that premium could, that buying surge to try and get exposure to metal or prices of metal could actually push SLV higher. And then ultimately that premium doesn't come down. And what could happen is you may have authorized participants, or individuals that already own the shares may try to get redemption of the silver that's in the fund, and that could create some chaos in the fund itself. But structurally, the fund doesn't really trade in and out of the market. It's the authorized participants that trade on behalf of the ETF, and that's true with any ETF out there. That's why the structure of the ETFs, they try to keep that NAV, intraday NAV, close to the market price, so traders don't have to worry about premium and discount, risk arbitrage, things like that may mess up sort of the order flow or the ability to perfectly time the market, like you're doing with an underlying security. So that's kind of what could impact SLV. I think it's structurally, it works different than closed-end funds as well, but we can get into that if you want to.
Okay. Well, I appreciate you mentioning that, because I've been thinking a lot about those redemptions and the creation of baskets, which sounds like is pretty much just to balance and keep that arbitrage with the futures in line. Although, Bob, in there, you also mentioned Steve St. Angelo, and I wanted to start getting to some of our audience questions here, although I have a couple more as well, and a few more of your comments pulled up that I think people will be interested to see. Yet USB in first try mentions here, Steve St. Angelo will be on soon. That will be tomorrow. And Steve says, peak oil will make the price of silver go up. We are seeing energy prices skyrocket. Can Bob comment on that? Actually, I might recommend Palisades Radio after we're done here. Steve and Bob were both on that call and talked quite a bit about some of those things. But Bob, any comments on that did you offer today?
Yeah, what's impacting the mines? I mean, you have labor shortages, rising fuel costs, rising equipment costs, or delays in actually getting parts and equipment supplies and things like that. Those have been impacting the mining stocks or the mining companies, this last year or two, or I should say really the last year, because that's when oil really took off after Ukraine. But and that's why you've seen such bad performance in the mining stocks, because this is where it gets kind of interesting, is that the mining companies, their costs are typically in the local currency. So if they're down in Peru, for example, mining metal, they're paying their locals in the Peruvian currency. The problem is when they pull that metal out of the ground and then they sell it, if it's gold, for example, and they sell it to Switzerland or to the United States, it's denominated in dollars. So you've had an underlying commodity that's priced in a currency that's been going straight through the roof, and their costs are all in local currencies, which the currency has been falling like a rock. And so they're seeing inflation locally, but they're selling an asset that's in a deflationary move at the same time. So that's the worst case scenario for a miner, because all of a sudden they're not getting as much for that product to compensate for all their expenses. And that's where some of this rolling forward contracts and trying to delay delivery to try and hope that the price turns back up. In some instances, those mines desperately need a higher price. They may be right at the cost of production. I know Steve talks about the cost of production of the primary silver producers, maybe $19 an ounce, I think, at this point, with oil coming back down a little bit. Yep. But that's still, when you're talking about the cost of production, I mean, that's basically your break even. I mean, you're not making money at that. You still got to try and make some money for the company and for the shareholders. You're just not in a charity or a charitable organization when you're mining assets. So that's creating an issue for the mining companies, and in turn that creates maybe some visibility issues about when, how the flow of metal coming into, refiners, how much they can count on that metal coming in. And so it was interesting because we saw something from the LBMA as a news release, and I think I put it out yesterday, how the LBMA now is going to create a program for the small artisanal miners. And so I think that could be a real indication that they're willing to open up that market now, maybe because of supply issues, to try and get more supply from the smaller miner out there, which typically may have been shut out or had to go basically through back channels to sell that product, and obviously have it watered down in terms of what they were getting for it to flow through a LBMA type refiner or have it accepted like that. So that's something that I saw was worthwhile noting. So there's concerns about supply out there, and that then turns into the 1,000-ounce bar question, which is what I've been focusing on. Is if the 1,000-ounce bar market is the Achilles heel of this industry. I mean, that's where fabricators or the refiners use for melting the products with, the ETFs buy for investment for their holdings. Investors will buy it and store it like in the eligible category on the COMEX. A lot of that eligible category is mainly, I think, metal that sits there and collects dust. It's metal that may eventually come onto the market if the price hits a certain target, or the person holding that metal decides they want to go ahead and sell it. But it's important to note that the COMEX eligible category is metal that isn't on warrant. So it doesn't, there's really, when you take metal out of the registered category, you're taking it, usually when you put it onto the registered category, the advantage is you're getting some type of leverage or collateralization with that metal. So you're doing some type of financial transaction a lot of the times, whether you're writing calls against it or rolling contracts, or maybe trying to play spreads, that type of thing, or using it to do relative value trades, using the metals as collateral and then buying the S&P 500, for example, or some other type of strategy. But that's why you would put it onto the registered category. When you take it off the registered category, what you're doing is you're basically putting it into sort of a cash account, private account that's being held for maybe longer term purposes. It's not being used as, the sole function is not best necessarily being used as a collateral type of instrument. That's why a lot of metal that's in that fashion is done in London, because in London they deal more with some of the OTC type of transactions and some of the loan, lease, repo type of situations. The liquidity there may be a little bit better for that type of market. So when you see the registered kind of narrowing down here, that's metal being pulled off the market. That's really going to fabricators. That's like the U.S. Mint taking delivery. They're not taking delivery directly. They're buying it through CNT or TD Bank or whoever their vendor is. But those guys will go onto the market and pull it from the COMEX. They may have COMEX contracts or warrants. They break the receipts. They take the delivery of the metal, and that metal goes into the eligible category for a day or two or a week, and then eventually you see it leave the eligible category, and then just it's out of the system. That's what's been happening with silver for the last year or two. With gold, it's a little bit different story. Gold, you're seeing a lot of metal leave the COMEX, but with gold, a lot of that may have been leased metal that hedge funds put on account and then use that metal as collateral to do other trades with. And so when lease rates spiked over the summer, you saw a lot of metal starting to leave at that point, because for a hedge fund that with that lease rate going up, it just didn't make sense to hold on to gold anymore. They just let the lease expire, redeliver the gold back to the refiner or wherever they borrowed the metal from, and that's why you're seeing that drop there. So it's a little bit different environment, I think, than what you're what you're maybe what's talked about amongst the precious metals community. I mean, everyone talks about manipulation, but there's more to this than meets the eye. Yes, there's manipulation in every single market. I agree with that. Yeah, and it's kind of been proven, I guess, in different types of ways. But it's easy to have influence in short-term price action. But I think it's important to note the longer term picture of where we're headed, and not to get too focused on the price action initially, because there's a lot of noise here that's going on.
Well, I think that's well said, and there are a lot of other factors going down, which leads into a question that just came in from Lantron, and saying, which kind of answered the first half of this: does the COMEX drain numbers matter? And also asked, will JP Morgan release the 300 ounces from eligible to smash down the price once registered is drained? I mean, again, as you were saying, kind of hard to know exactly what are the plans for registered, let alone the eligible. But any thoughts on either of those two questions there?
Well, in terms of when you're talking about 300 million ounces, let me just try and pull up what are they talking about with 300 million ounces at JP Morgan? I guess that's what are they talking about what's in New York or
Yeah, I believe referring to what they have in New York and perhaps mixing that with the eligible pile.
Because I'm showing the eligible only 145 million ounces. And a lot of that may be SLV's metal that's in there. So it's JP Morgan is just custodying that. They're just the custodian for SLV. They don't really have any management control. It's the authorized participants that end up having that management control of creation and redemption of shares. And JP Morgan Securities may be, I'd have to check. There may be a subsidiary of JP Morgan Bank that actually is a authorized participant. But again, those guys work more on the arbitrage of just trading for a spread on a day-to-day basis, more so than a directional move. Now the question is what the way and that's their interaction with the SLV. Now the action as an authorized participant, that's totally different. How they actually hold their inventory, maybe that they have set aside, whether they hedge it or they lease it out, or they borrow some of that metal for short-term swings. For example, if it makes a lot more sense to borrow some metal, and then because the premium on the paper side is so great that it makes worthwhile, even though you're paying the interest on the borrowed metal, you can deliver that metal and then take that metal back at a certain period of time in the future. Whatever the transaction strategy is, it's important to note, and I mentioned this in the Spaces call, that the borrower in London, actually title goes with the borrower of the metal, not the lender. And so you start to learn some of these nuances that happen in London, because London is a very opaque market. There's not a lot of reporting that goes on of how the authorized participants work on a day-to-day basis. It's not as nearly as transparent as the COMEX. The COMEX actually has much more auditing and reporting that's done, especially with these stock reports that are done on a daily basis. You get to see the flow of the market almost real time, which is kind of nice. Now the issue with trading is a totally different story. Whether like the spoofing incident, yes, anybody can try to sort of influence the price action on a day-to-day action, or hour-to-hour or minute-to-minute type of thing. But again, when you're watching physical metal, you're really like the turtle and the hare type of thing. You're really in this thing for the long term. So what they do on a minute-to-minute basis to nail the price, does it really have any bearing on the flow of the physical metal and the tightness that's developing there, and how mines are starting to run into potential issues? Because you gotta remember, silver is a byproduct. 70% of the silver that's mined is a byproduct of other metals. So these other, copper's been hit, zinc's been hit. I mean, everything's been hit. So that's impacting the potential byproduct of silver as well. So there's multiple things that are hitting silver at the same time that ultimately I think will actually play out rather well. It's just, to the investor, I just keep saying, be careful not paying too much for your product, because at the end of the day, we're in this to try and make some money, and protect our purchasing power, not to give it all away. So.
Well, that makes a lot of sense. And in terms of some of the dynamics you mentioned there, because we're seeing it on the supply side, and obviously with silver at $18 or $19 and cost of production around that level has come down a bit with the lower energy. But yeah, Steve St. Angelo did mention it was around 20 and lower end energy slightly lower. It's not as if people are running out saying like, oh, this is the greatest time ever to start a silver mine. And you've talked about some of the things going on with the geopolitics. And I found this tweet that you made, I believe this was last week, pretty interesting, because I know there are some people, I've tried to be careful on this, of not going overboard saying silver is going to X or Y price tomorrow. And I know that you're generally pretty conservative. So I found it quite interesting. Read here, we could be on the verge of a massive force majeure in precious metals if prices continue to drop. And you commented on that a little bit in the Twitter spaces, but for, again, maybe anyone who didn't get to catch that, was really interested to hear that. And perhaps you could comment a little more on what you're seeing there. And I'll just add to people, if you want to keep sending in questions, I am ready to take them. So, but Bob, if you could share what you're seeing there.
Yeah, like, for example, a great, like with Steve St. Angelo, his chart with Peru and the decline in mining production, and you see it with South Africa, you see it with certain countries that, their costs are rising. The mines don't have complete control over their own cost structure, which is the hard part with mining. I mean, they can't control the price of diesel. They can't control the equipment chain for repairing their vehicles or machines, whatever it may be. So they're at the mercy of things that they may not have control over. And when you start to get the price falling, if some of these contracts, can you hear me okay?
Yep.
Okay. Yeah, I had some weird thing. So when you have if you have a hardship provision in these mining contracts, so these delivery commitments to the refiner or to the bullion bank, and the mining company says, hey, listen, I just can't make any money at this anymore, or it's not economically feasible, I'm just losing my shirt. I can't make the commitment that maybe I made to you 3 or 4 or 6 months ago, whatever it may be. What happens is that starts to flow into a channel where if that bank or that refiner can't get metal elsewhere because he has a commitment to, say, an industry like Apple for their phones, or whoever it may be, platinum cali converters, the metal for that, or whatever it may be, or just to wholesalers, to then, so the wholesalers can then sell the product to the retailers can sell it to, but if you break that channel a little bit, or you start to constrict that channel, they don't have any control on, if they can't get that metal from the mine, and you start to see the COMEX drain down in inventory, which I think that's one of the other reasons why you're seeing the backwardation issue. Is I think the refiners are saying, listen, we need to make sure and lock in our source of metal, because it's not just, hey, listen, the premiums are high and we can take advantage of that. There's real demand out there. I mean, you're seeing China, for example, you'll probably see their numbers pretty strong for October, but of course, so some of that is actually due to the Chinese New Year holiday. I think that's also what's kicking up the premium versus Shanghai to London. Is you see that holiday buying in China. When they come back off a holiday, they tend to buy because it's a market that kind of goes dormant during that holiday. But these are all things that India buying a bunch. I mean, you have global currencies around the world that are taking nosedives, people waking up to that. So it's not just a US centric story, it's a global story. So if you're, you're in Britain, UK, and you're like, oh my God, I've never bought metal before in my life, and the pound just dropped like a rock. What do I do? How do I protect myself? Now, at this point, it may be a little too late to buy, high premium products over there, but that's how people do. That's the Western culture, is you buy when it's high and, hope that it goes higher. It's a momentum trade. What we haven't seen though is the dollar peak yet. And when that dollar starts to roll over, when it's our time to do what all these other countries are doing, and the economy starts to hit the skids, and because of all this tightening of policy and so forth, and the dollar starts to pull back and starts dropping, the dollar is going to be our relief valve, I think, to try to equalize our debt servicing payments, and that's why you see media do a great job of basically crapping on gold and silver as an inflation hedge right now, and getting everyone lathered up thinking, oh my God, this is the worst investment to own in an inflationary environment. But what's actually happening is the environment really isn't changing. It's just that the dollar's been strong right now. It's just that won't go on forever. And when that shifts, you're going to get this big reversal, and then and you got this really bad sentiment that's out there for the metals right now. Well, when that turns, you're going to see, I think, probably a much greater wave of investor demand start to move back into the metals, especially if there's more mistrust in central bank policy. If you see fiscal policy next year start to maybe expand deficit spending even more, because if we do go into a recession, there's going to be a battle cry from the constituents and citizens out there that says, listen, we're hurting, we need help. And this whole world has been turned into, from monetary policy affecting interest rates, to fiscal policy. And when you give someone the power to vote and to create and basically to write checks from the checkbook, they're going to take advantage of that. And that's what we've been seeing here. And I don't think you're going to have the discipline in the United States to weather that storm. I think the power structure, I mean, you look at Biden and the executive branch, they're to drain the SPR, the Strategic Petroleum Reserve, down just because they want to get oil prices down, to try and get gasoline prices down, to try and create the image that inflation isn't as bad as it is. So they're the midterm elections, they have an opportunity to maybe control the House and Senate again. Well, at least the House. Those are long-term problems that start to develop off of that, and that's where I think. Again, why I look at physical metal. I don't know where the mining companies are going to go a year from now. I mean, if oil goes back up to $140 a barrel, for example, and there's some type of event happening in Europe again, or something, Taiwan happens, or something blows out, anything can affect the mining production, the cost of production, all that kind of stuff. But having the physical metal in hand, I think is really, David Morgan says it best. That's your core of your portfolio, should be in physical metal, because at that point you don't have anyone else's promise to pay. And I think that's where investors are going to start focusing, and that's what I want to try and do, is get more institutional ownership in that physical metal, and that'll actually start moving the price higher. And I think that's what the industry ultimately needs, is really a higher price, not a higher premium for product. And I think that's where, if people start buying 1,000-ounce bars, for example, that'll start pushing the price, because at that point, people will start paying more for that 1,000-ounce bar, which will ultimately affect the exchange for physical premium, exchange for physical contracts that based off of the futures and spot prices. It'll have a broader impact on the overall pricing structure of the market.
Yeah, I think that makes a lot of sense. Where I wonder if the last piece is when we really finally see the price move higher and not come down sharply, because really for the last 11 years on the way down from 50 certainly, but even it's like the silver market starts to rally. And I get it, if Tesla just goes up inevitably and people are making a lot of money, then obviously people want to do well on these investments. And certainly seeing some institutional interest come into silver. could well be that spark. Although we have a question here from my good friend Alan Van Cleve, who I had the pleasure of meeting at the Silver Symposium. I think he wanted to meet you, Bob, didn't get a chance to, but he said he heard a rumor that they were flying silver to London to cover deliveries. Bob, have you heard anything along those lines, or any comments on that?
I don't know if I've never heard that. From what I've been told, that silver's going more to refiners. Now, they may be fulfilling deliveries or delivery commitments that were made in London, and it's simply being shipped, straight to India or straight to Switzerland or straight to, another refiner, in another country. That could be what's happening. But I doubt they would ship it to London and then ship it out to London to another refiner. It would just be going on a boat someplace else. The one thing I would mention too, for the retail public that's buying metals, is that when this price starts to move, there's going to be a level, and no one knows what that level is going to be, but maybe it's $35 an ounce, whatever that number is. We may hit a point where you start to see all the secondary supply that investors have bought the last 20 years, whatever it may be, start to come back onto the market. And this is why I try to help people and educate them and say, listen, don't pay too much for the product, because even if the price starts to go up, the premiums at some point are going to drop, because you're going to get secondary supply, secondary selling that's actually starting to come loose from investors' hands. And that's something to be cognizant of, not trying to buy a Silver Eagle at $18 over spot right now, because you may not make any money on this thing. It'd have to maybe go over $40 an ounce for you to make money. You just don't know what the market's going to look like if the price of silver starts to rally, because you're going to have a lot of people holding on to this stuff. I mean, you got to remember, in 2011, 12, 13, there were twice as many Eagles made then than there was in the last couple of years. There's a lot of overhead supply out there. It's just, I think it's going to take a higher price though to shake that loose, and the industry needs that. They need, the scrap market is, it's not as what it once was. A lot of people that had scrap have already sold it into the market. So you're not, there's not a lot of sources of metal to help with the supply or sourcing of metal. So the that's where typically price tends to be that barrier of relief, I guess you could say, where all of a sudden, at a higher price, the cure for high prices is high prices, but the cure for more metal coming onto the market is high prices. You're not going to get it from just simply wholesalers offering bigger premiums on products in the hopes that they can shake out someone that says, listen, I'll sell, my Silver Eagle at $8 over spot. Well, what am I going to buy with that? Another overpriced product.
Well, I hear you. And we did have another question from Land come in, really talking about the dollar index, which obviously is on the higher end now. And I think he said the last time silver went to $47, DXY was at 73. Is that going to be your primary driver in your opinion, Bob, or anything else? That is it just waiting till we see more overt chaos, or are you looking to the dollar index? Obviously, seems like there are times where dollar index up, metals hammered pretty reliably, or the vice versa. But is that one of the indicators you're looking at?
Yeah, I think ultimately, when the metals start getting into high gear, it'll be that dollar index will start dropping. What'll be interesting though is, I think there's going to be a point here where the dollar index goes higher, and the metals stop going down, and they start moving higher as well. And I think that'll be the point where the metals start to sense that the dollar may be near its last hurrah, where the debt servicing becomes a real issue. You got to remember that the Treasury is rolling over. I mean, they're rolling over like what, $7 trillion of debt a year, or $5 trillion of debt a year. I mean, it's an enormous number. So when they roll that over, you're automatically ratcheting up your interest expense, from 1 or 2% to, now it's doubling to 4%, whatever it may be. That has an impact, and the markets will see that. And if the Fed that's the problem with the Fed right now, is that, they're reducing the balance sheet, but the problem the market has is there's nobody to buy the debt or the deficit spending and the new bonds that are coming onto market. There's no way to absorb that. And you see, that's why on Friday you had Yellen talk about, well, maybe we should be buying some of the debt, the treasury debt from the banks. Well, no crap. I mean, a lot of this debt on the treasury, on the bank's balance sheets aren't marked to market. I mean, it's held for maturity. It's from an accounting standpoint, only the securities that are available for sale are marked to market. And that may be more the primary dealers and so forth, but or a smaller section on the capital group. But the real issue is the primary dealers are hurting right now. I mean, you're seeing a bond market that's just getting bludgeoned. And there's no end in sight right now because inflation is staying sticky. It's not coming down like a rock. Now maybe you may see some reprieve, 3 or 4 months from now, when all these rate hikes and the balance sheet tightening runs its course and slows the economy down. But the worst case scenario would be you have a dollar that starts to drop, and now you have that to contend with even though interest rates may be dropping, you have a dollar that starts falling. So then commodities will key off the dollar and not necessarily the economy. And then you have stagflation. And that's something that, again, we haven't seen in this country for 50 years, since the 70s. I mean, so the dynamic of the market is different than what we've seen the last 15 years, where they've just printed away all the problems. Anytime you've had a dislocation of the market, let's print more money. Let's do some fiscal spending. Let's, throw some leverage on there. I mean, I think you hit the max point of, hey, this is about as much as we can, we've redlined the engine for 15 years here. And I think earlier this year, I think we basically maxed that out.
Yeah, it does seem like it, and I saw that story along with you on Friday, where it just seems odd if Janet Yellen's going and asking the banks what to do now, and I guess we'll see how that works out. But Bob, it's been great what you've shared here so far. I want to be respectful of your time, although perhaps one last question that I think would be great if you could touch on. JM Unleashed asks, will we ever see physical silver premiums back to pre-pandemic levels? They come back down, or is that possibly before some of this stuff really starts to unravel? That will we not see that again?
I think that would be wishful thinking. I mean, you've had the mints and refiners both raise prices. The U.S. mint, pre 2020, I think it was they sold silver eagles for $2 an ounce to the authorized participant. Then COVID happened. They raised the prices to, I think, 235 over spot, and now they're 295 over spot, and they're probably going to raise prices more again with the 2023 product. So you've had mints technically raise prices because their input costs have gone up. Shipping and minting and labor and all these others. Gotta remember that, some of these mints, well, they're sovereign, so they don't really probably borrow money, but private refiners, they may have higher capital costs, financing costs, that type of thing. Plus you have higher leasing costs, and that adds into the cost of production as well. How you actually obtain the metal to make the product and then replace that leased metal. Those are all transactional costs, but those have all gone up. So to really look at what it used to be, I guess the easiest answer would be those were the good old days. So
I think you may well be right there. And who knows, maybe we'll finally see premiums come down and actually see the spot price go up. Would be nice to see that as well.
yeah.
Although, Bob, before we wrap up, I want to thank you again for making some time to join me. I know we've been scheduling this for a while, but I think this was really helpful for folks. And perhaps you could just let them know if they have questions on products. I know that, and I'm finding your page with your site here. I know that you're also trying to help people avoid overpaying for stuff. There's good dealers out there. There's some that range always in between, but I appreciate you make yourself available. I know you're active on Twitter. can you just let folks know how they can find you if they have questions or would like to know more about the services you offer?
Yeah. Goldsilvervault.com, just gold, silver, VAULT. And then you just go into the upper right-hand corner there. There's a special pricing section. You could click on that. That actually, it's buying precious metals. It's not fancy, but you kind of give a little bit of some indications of price of what you can buy products at. So that way you can, if you have a favorite dealer that you're working with and you want to stay with them, great. But at least you have maybe something to haggle with or negotiate with. And then, but we definitely we drop ship as well as we store at the facility. There's a couple different pricing for either choice. And then we have a video section or media section, blog section as well for articles that we wrote or interviews that we've done on here, as well as our storage fees and agreements and that type of thing. Tells a little bit about us, what we do, so they can get quite a bit of information. And then I also have, I think under the media section, if you scroll all the way down, I think it's under media. Just just go to up at the top. Hit that media and just do article interviews. And then you scroll all the way down. That's some of the interviews I've done. But all at the bottom is our rolling Twitter page, Twitter feed, I guess you could say. And so it kind of puts Profits Plus ID is my feed, PROFITS PLUS ID is in Idaho. I try to put out, quality information, actionable type information, which, people can kind of understand what's happening with the markets, get a little bit more depth. Maybe not necessarily hearing the same thing over and over again, but just different types of information that says, okay, this is how, an ETF works, or this is, how London works, or this is the, the COMEX and how it operates and what it means when you talk about backwardation and some of these technical terms. I try to put stuff out there it's a little bit more meaningful, that kind of explains why things happen the way they do. So hopefully that kind of helps people. Yep, that's pretty much it.
Yeah, and I'll second that on the Twitter feed. You have a lot of these things that you unleash. This one was 16 parts, but really explaining some of these things that get tricky to understand. You're talking about COMEX and the NYMEX and some of the, I believe this was the one where you mentioned the open interest, also digging into SLV when it's trading a premium and a discount. And I'll read those through several times. And in fact, Bob, you might be happy to know I have on my phone, I get Twitter notifications every time you tweet something out. I'm seeing that. And certainly as someone who's just trying to understand the silver market, you really do share some great information. So again, goldsilvervault.com, Profits Plus ID on Twitter. And really just appreciate you joining me. It was great to finally meet you in person and in Spokane about a month ago. And I think you're doing good things out there, and I know you do have a genuine intent to just help people get good information and understand the things that are going on. So thanks again for being here today, and hopefully that was fun for everyone at home, got some questions answered. Appreciate everyone out there who's watching, and we'll look forward to doing this again soon.
Sounds good. I appreciate it.
All right, and we are clear.
Okay.
Cool.